The rubber is about to hit the road hard. Too many people not paying rents. Too many people not paying mortgages. Too many small businesses are going bankrupt and leaving their loans uncollectible. Too many write-offs. All the liquidity in the world does not make up for actual losses on the balance sheet. Every dollar borrowed is both a debt and an asset. When the mortgages go into bankruptcy, suddenly you are staring at a balance sheet with a lot of debt and no asset. The books can be cooked, and they will make themselves look better, but ultimately all the cooking just makes things worse. Hold onto your butts, the bankers are about to squeal like pigs. The credit defaults will put a hit on banking. A huge jump in unemployment claims will spell the beginning, not the end of this crisis. The default will probably rise before the layoff, unemployment no. The negative demand shock will cause a sudden default to incorporate, then unemployment. That is what Fed and the EU Central Bank is afraid of. 28 million, or 1 in 5 Americans who live in households that rent, are facing mass evictions. Half the country's rent moratoriums are over. Courts are filling up with eviction cases. And the problem gets worse, that is, because when rental income for landlords collapses, they will experience financial hardships as well, including servicing mortgage payments and inability to cover other building-related expenses, if those are fixed or variable costs. Over half of mortgage payers haven't made a payment in months. Even though most banks are only servicing most mortgages and aren't the owner-investor, the banks still have to cover the first few months of delinquent mortgage payment per most investor contracts. That's a serious coin for millions of mortgages if the borrower never cures the loan and defaults. Additionally, banks have to write down the value of their mortgage servicing rights when a loan defaults. All that said, it's still better than being the investor backing the loan, but banks still take a decent-sized hit when loans start going bad, even in relatively small numbers. Nearly 10% of overall bank funds are tied up in bonds and loans to the energy sector. At this time, with oil below $40, the bank's energy sector liability is incalculable. With more and more brick-and-mortar retailers going bankrupt, resulting in more and more vacant stores in shopping centers and malls. The banks holding the loans on said properties could see many related commercial property loan defaults.